Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for June 15th of 2025. Welcome, everybody. We have a lot of ground to cover, so let's jump right on into it, shall we? Okay, so what are CEOs worried about at this juncture? We've seen a lot of market gyration. We've seen quite a bit of economic data over the last few months, dating back to the announcement of the tariffs at the beginning of April. And so here we have a chart that kind of gives you a sense of heading into the second quarter, really almost concluding the second quarter. What are CEOs most worried about? You can see here geopolitical instability. Obviously, over the last week, we've got the Israeli attack on Iran. We've got trade and tariffs, which is still out there, by the way. And we do have some of the expiration of those 90-day moratoriums set to expire early next month. And then regulatory, legal uncertainty and trade and tariffs. This really wasn't an issue in the first quarter and obviously came to light in April, but geopolitical instability picked up a little bit, as did legal and regulatory uncertainty. And you can see these other things have all kind of taken root, and in some cases we've seen increases over the last several months. AI, supply chain is still out there, oddly enough. Financial economic risk is still very much in the calculus. These just happen to be probably the most publicized right now, but just suffice it to say that, financial and economic risks are still very much in the minds of executives out there. So a chart that kind of talks about valuation. We're going to talk about the markets here for a second, and then we're going to jump into some other economic data. But here we've got value versus growth, and what we can see here is that when we look at the ACWI, this is the All Country World Index, ex-US. So this is truly, this dark blue line really represents the global backdrop, where obviously we've got the S&P 500 here. And so this is value versus growth. And we know that growth has been underpinned by the Mag 7. And here we've had a continual underperformance on the part of value. And you can see that here in this light blue. Whereas, interestingly enough, overseas, value has exhibited much stronger performance. Now, transitioning over to valuation, we've got next 12 months price to earnings ratio. Here we have the capitalization weighted index, and you can see that we had, we re-rated in the wake of the tariff announcements and this so-called Liberation Day, but we've almost gained all of it back. So we're back to about 22 times next 12 months earnings on our valuation. And in a similar fashion, when you just take all of the 500 constituents of the S&P 500 index and you weight them equally and not by capitalization, you get a similar dynamic in the sense that valuations are back close to where they were before we had this reset in the market. So, this is perhaps a good buying opportunity down here when you get those valuations that are kind of troughing. You can see data going back to 2015, that we were back in levels, at least on the equal weight, that we had, seen multiple times over the last 10 years. Still a little richly valued, perhaps on the cap-weighted index, but again, those have reset, so valuations are back close to where they were, and they're not necessarily cheap. More charts on the equity situation, actually here on asset allocation. So you can see that investor allocations to equities, as this chart suggests, is at an all-time high. You can see that really going back over the last decade or so, how much that's increased at the expense of debt, and you can see cash balances rising. And we do know that there's still a lot of cash on the sidelines, which is not terribly surprising now that you're actually getting paid something to hold cash. Which is not the case, 6 to 8 years ago. Now, household holdings of equities as a percent of total financial assets is also at a high, and this data goes back to World War II. And so this is very interesting. And what this implies is that the consumer behavior can be modified quite a bit more by what happens in the equity markets. And it didn't used to be the case as much when we were back here, even back in the decade following the global financial preceding and including the global financial crisis after the tech bubble. When you think about investors and how they respond to dramatic changes in the equity markets, well, obviously, if you've got 30% of your household holdings of equities as a percent of total financial assets, you're going to be much more swayed by, say a 10 or 15% downturn in the market than you would have been in these prior periods. And it could have a much closer tie to household economic data, which, as we know, households are 2/3 to 70% of the total economy. Quick chart here on investor sentiment. You can see here that we're well off our peaks in sentiment. We did get a bit of a recovery over the last month or so, and now it seems like with valuations being a little higher than they have been, that investor sentiment's kind of being held in check once again. On this chart, we talk about fund flows, which have been a little volatile over the last several years. You can see here, as of late, we've had some outflow from retail investors from U.S. equities. That number was about $29 billion last month. And interestingly enough, we've seen $29 billion of retail outflows, and some of that going back into European stocks, which have been outperformers this year, which if you look over a longer period of time, European stocks relative to US stocks have actually done extremely well. And so this is an interesting dynamic that we have seen a notable shift into international by a considerable number of retail investors who traditionally are very, very underweight European stocks. So we just got through talking about the market having recovered from its post-quote Liberation Day tariff drops, and valuations have picked up and are very close to the pre-announcement levels. And the other, basically when you talk about PE, you're talking about price to earnings ratio. And of course, you've got growth in price relative to earnings. And so it's very important to look at earnings growth in these markets to see, what could be the potential trend for valuations looking ahead in the market. And interestingly enough, we've got a couple sectors here, industrials and capital goods in particular, where earnings expectations are at or near their lows, their historic lows relative to the broader market. And so here we have in both of these cases, where earnings expectations are extraordinarily low and really set the table perhaps for some outperformance in the future, at least from these areas of the market. Again, if these expectations are low and then they come into they come in better than expected, then that obviously makes those valuations artificially low. And here we can see relative forward earnings momentum has troughed. And again, if you have the ability to outperform the expectations, then that sets up a pretty interesting point for these particular sectors of the market. I really like this chart from Alpine Macro. It looks at a couple of circumstances, points in time. We got 2017, 18, and then in this black dotted line here, we have the current environment. And so what Alpine is really kind of the point that they're making here is that you've got really two routes to go. And so, you've got policies that, tend to expand economic growth and opportunity, which would make this feel a little bit more like 2017, where we had deregulation and we had reforms in taxes, or if we had the trade wars that intensify. And again, as I mentioned in the first slide here, we've got the moratorium ending on all of those tariffs, which honestly I think are apt to be extended again. But again, that's not by virtue of any kind of clairvoyance. It's just a presupposition that I think the last thing that President Trump wants to see is us to reverse stock market gains, and and obviously that would impact his poll numbers. So, but that basically we've got two options here, and obviously 2018 was very noisy, and then when we had the tariff impositions on China, which were not nearly as bold as the ones that were announced back in April. The market meandered somewhat. It did go up, and then we had a really kind of a tough end of the year in the markets. And so, Alpine is just saying, listen, we've got really two routes to go, and I don't think we've really defined what that path it looks like yet. Another chart here for historical relevance. This really speaks to the power of dividends, and it happens to be one of the underpinnings of our equity strategy or our philosophy right now. Is that, and again, more for educational purposes than anything else. But you see here that if you go back basically, to March of 2013. And you reinvest those dividends, which aids in that compounding, that your return is actually 34% greater than if you'd paid those dividends out. So, for those of you out there that, have longer term horizons where we are reinvesting those dividends, then dividends really do matter in the sense of contributing to total return and are not to be underestimated. This is a chart that I happen to find pretty interesting here from Apollo Academy here, and basically you've got half of the new product in the market for fixed income the new product coming to market, half of it is in treasuries. So this really speaks to kind of a crowding out of treasury borrowing, and as we all know, we're dealing with some pretty stout budget deficits as well as an ongoing, deficit, an increase in these deficits by virtue of the policies that are being talked about in Washington and this big, beautiful bill, which is it's certainly going to expand the use of, or expand treasury issuance here. But if you add up corporate bonds and mortgages and also municipal securities in terms of new issuance here from the fourth quarter of 2023 to the end of last year, you can see that roughly half of this is coming in treasuries. And I don't know that this is particularly sustainable. Not something I really focused on until I saw this chart, and it did get my attention that basically it crowds out private borrowing, and when you think about plant expansions, capital improvements, infrastructure development and things like that, you would much rather lend, you'd much rather have these types of numbers a lot higher than treasuries, but that's just where the world that we live in now. So the Fed is still probably on pace to cut twice this year, maybe, all right, but they're not going to do it while we have a lot of tariff uncertainty, and obviously Trump has gone ballistic on our Fed chairman, and but the best assessment at this juncture is that we're going to get basically about 2 cuts priced in by the end of the end of the year, and these are the Fed meetings that are left. They meet roughly about every 6 weeks or so, and this is kind of the sense of where we are now. That again, I'm not entirely sure personally that we get 2. I just think the data really has to support it, and Fed Chairman Powell is willing to stand up to President Trump, who's been calling for these cuts. His term is up next year. I think he probably makes it to that, and then I'd be very interested to see what happens in terms of who gets appointed to replace Jerome Powell, somebody who's going to be much more acquiescent to our chief executive here. And what does that do to the dollar? And so, and how do we look at the U.S. dollar, which has actually been on the slide for some time? Here's the dollar index, DXY, on a year-over-year basis. We did have a fairly strong pickup last year, and we basically have given all of that up. And then we have the leading indicators for the dollar basket here, and this is basically being pushed forward 6 months as a means of kind of forecasting where the dollar is going to go. And at this juncture, those leading indicators are suggesting that we'll have more dollar weakness, which then has implications for exports. That would certainly bode well for if our goods priced in dollars are cheaper, relatively speaking. It's generally better for commodities that are largely priced in dollars. So there are some tangible benefits to dollar weakness, and it has something to do with expectations in the market for rate cuts. As rates go down, dollar becomes less strong or less desirable relative to other currencies, so on and so forth. Here we have tariffs, still in the news. Mentioned a couple times already that we've got the moratoriums that are set to roll off if they're not renewed or extended. These charts just really highlight the fact that despite all the hot air on this topic, we have had revenue that has gone up from tariffs. Now, the question is who's paying for it, and I think clearly, consumers ultimately are. There are a lot of middlemen that are absorbing this so as not to hurt their competitive position or whatnot. It is certainly going to be an impact to margins, but you can see here duties collected from imports on a monthly basis have really skyrocketed in a fairly short period of time. Now, the big question here is how long does it take and how much is it going to eventually filter into the consumer level? And I think we can look at consumer electronics and a couple other areas where that's clearly happening now, but it's not broadly based just yet. Now we actually have, despite tariffs and geopolitical events, we actually had economic data last week, and we had U.S. producer prices announced. This is month over month in both the all-in as well as the core. They both did go up, but they were both below expectations. So here we can see that we've had a preponderance of higher PPI data after that came down quite a bit. This is core in particular, but same dynamic that we saw at the headline level. Core just simply means X food and energy, but slight uptick, not to be certainly expected with tariffs at bay here. So, but good to see it's not it certainly wasn't. It was better than expected. Put it that way. Here we have CPI, this one slightly mislabeled, but this is the overall CPI and then the core CPI. And just like producer prices, consumer prices were lower than expected as well in both these cases. And you can see the trend line, very similar to producer prices here that maybe bumped up a little bit, over the last 6 to 9 months. You can see the core CPI data on a monthly basis. You can see that we were clearly, and I argue still, are in a downtrend for inflation. And I think if you get and again, we didn't get the tariff bump, and I think we probably will. We'll talk about that in a second. But once we get that, I think tariffs are largely a one-time dislocation. So you basically change the base price level because of these tariffs, but then the rate of change is minimal after that. You're not consistently raising prices due to tariffs. You just change it like one time, and then that ultimately is going to impact demand. But again, last reading, we didn't really see a lot of materiality in changes in consumer prices. The inflation surprise index has actually been very positive, meaning that the expectations have called for more inflation than we've actually received, and that's pretty interesting. That's actually good for the market, and I think it has contributed somewhat to the positive the positive equity environment that we've seen really over the last 2 to 3 weeks. So talking about the tariffs, I think the expectation is we're going to have more impact. And I think these charts really talk about that. And even though we had better than expected consumer price data, you can see here that in this red line, the share of tariff sensitive components of the consumer price index, which rose in each month. And you could see, January, I mean, we didn't really have, tariffs that weren't, we knew that there was going to be some announcement at some point. It really was April when that changed. And you can see where this line sits relative to this line of best fit going back over the last, now roughly a year and a half. Really, it's not a tectonic change, at least not yet. But when we go over here and, we're looking at basically the expectations in those same tariff sensitive categories, then, what we're looking for is some reasonable impact from this one-time inflation offset. But very interestingly enough, that has gone down on a month-over-month basis. So those expectations in May were not as high as they were in April, and certainly not like over the last year in talking about tariffs. So again, we expect to see some kind of a bump in inflation to the degree that these tariffs are in place now. I'm not talking about the ones that are potentially going to reset and be re-implemented in July, but the ones that are in place now, really, there's going to be some impact, but it's not channeling through to this data just yet. So this is another chart from Barclays Research, and you can see here when we've got this, where we are right now is kind of like right here. And again, we haven't seen it in the data. Barclays does believe the tariff effects and the impact on core services again, this is like service-based inflation here, that the combination of those two are going to drive goods prices a little bit higher over the next 6 months, and then that kind of attenuates and then drops and then kind of flatlines at or close to 2%. You've got growth expectations, which first quarter we know is a little bit softer, and very interestingly enough, and we will get this data, we'll get the first reading of second quarter GDP or economic growth about the third week of next month. And right now, and you hear me talk about this all the time, the Atlanta Fed does a really good job in their data of hitting this number, and they've been very close for the last couple of years on their quarterly economic data forecasts. And right now they're looking at something close to 4, and I think consensus estimates are much closer to 2, but if we hit 4, that's pretty outstanding coming off a negative quarter, and certainly would not be indicative of any kind of recession whatsoever. So I wanted to put a chart in here on consumer behavior in light of everything that we've already talked about. This is something that we monitor pretty closely because it does have broad economic implications. Here we can see that basically that we've had a little bit of a drop in consumer spending. Certainly, on a month-over-month basis, we've been negative. That's not to say that consumer spending has been terrible. It's just decelerating, and we can clearly see that in this data here coming from Bank of America. And this is essentially credit and debit card spending that they're tracking, within their own purview. And you can see here, services spending continued to grow, and but you can see the impact of total retail, excluding gas and restaurants, here were both negative. And so you can see services, including restaurants. So again, decelerating somewhat in this red category. Real strong quarter here, not as strong and less strong in each of these quarters, but you did see a drag from total retail purchases, so it kind of dovetails what we see up here. And you can see that some areas that might be taking a bigger hit, as I mentioned, electronics from tariffs. You can see that those are trending a little bit lower, and then we've clearly seen less activity in TSA data, less international travel, like basically people coming into the U.S. from abroad. And then you can see lodging. So some puts and takes here. Maybe this is indicative of impact of tariffs and higher costs, et cetera. Not quite sure, but clearly we see consumers, maybe less robust than they were, even though it's not certainly a crisis point yet. You hear me talk about soft versus hard data quite a bit. Actually here we've got soft data in the green. You've got hard data here in this kind of aqua blue color here. And so, for quite a while, I was telling you about how the soft data was really getting like sentiment indicators and surveys were really poor. Well, actually, we had a kind of a flushing out of the market, and stock market began to go back up, and those things improved. And you can see here that we've actually reached almost an inflection point where the hard data that we have seen, again, softening, not indicative of a recession, but clearly some weakening in certain points in the economic backdrop have come down at a point where the soft data has almost kind of reversed itself, and you see a little bit greater level of complacency. We'll talk about the housing market for a second. Basically we've got several headwinds. We've got higher oil prices likely to remain a little bit higher for a while. We've got the impact of these tariffs, student loan repayments, and higher interest rates for longer, more than likely. That's combined to create some dislocations in our market, even though the market itself is healthier than it was just a couple of years ago. And you can see that, basically when we talk about home buyers, we've got home sellers that are outpacing buyers. And so this tells you that you're going to have, some moderation in price growth because of this dislocation. And it's not uncommon to have these kinds of dislocations, to be frank. Back in the last decade, we clearly had a situation like this, and you had a little air pocket before the pandemic, that was very similar, maybe not as great in magnitude, but again, I think this has implications for price growth, et cetera, within the housing market. So first-time home buyers, when we go back to 2010, they accounted for about 50% of all housing transactions, and that has gone way down. That's basically been halved when we go about 14 years forward from that point. And you can see that this has been a noticeable downtrend. So it hasn't been because of any one particular thing that's happened over the last 6 to 9 months, although it's been exacerbated by that. But you see affordability being much more challenged, and I think this has a lot to do with the fact that even though demand for housing has been fairly strong, you've had delays in new household formation, and you've also seen some more systemic kind of issues within housing, where you've had I'll just leave it at that, systemic issues in housing over the last decade. And this is a very interesting dynamic, that you haven't had as much impulse and influence from first-time home buyers as you did 14, 15 years ago. So anticipated rents, we do see here that we've got owner's equivalent rent, which peaked in early 2023. It continues to come down. And then we've got these other indicators that are basically put at a 12-month forward basis, and that would be the FRB New York and the Fannie Mae rent inflation data, and this is more forecasted. So this is trying to tell us that we're going to get maybe a trough here in owner's rent, and then maybe the rents go back up. This will be something that is pretty interesting to monitor, because this is an influence. This OER right here is an influence on core prices, and so it does have an influence on inflation. So we'll want to monitor this, and there is a decent relationship here between these three categories. This has been very interesting to see these Fannie Mae and Federal Reserve Bank of New York numbers move a little higher as of late. Something else that caught my eye with regard to housing, we've got the median asking price here, and a big delta to the median sale price. And so again, something else that tells me that price growth is going to moderate within the housing sector in the coming months. Now we'll switch gears here, talk about mergers and acquisition activity. That has been lower. You can see here a very noticeable trend here in 2025, and this has implications, to some degree on the private side. Basically the volume of transactions going down. It has implications for credit and financing, and how these the supply or the demand for credit and the demand for investment banking services and so on and so forth. And I do feel like this is kind of a pause. You generally only see these kinds of retrenches during recessions, but as I would strenuously argue, we're not setting up for a recession in the data right now. So consumer credit, we'll talk about the consumer again for a little bit. We saw an uptick in credit, about basically a 17% change here. This is pretty actually pretty dramatic when you think about it, and considering that we've had less demand for credit overall over a longer period of time. Now we have banks that are willing to lend on that, and you can see here you've got the consumer credit outstanding, which, as I just mentioned, over a couple of years has continued to go down. But we've got the SLOOS data, the Senior Loan Officer surveys, and this indicates a loosening of credit. And so by virtue of the historical relationship between these two data series, one would then expect, if you're putting this at a 6-month lead, that the willingness to lend is typically a leading indicator for what consumers will actually do. Is that the presupposition here is that credit outstanding will move higher as consumers take advantage of those opportunities. Delinquency rates, which we've talked about for quite a while here. Interestingly enough, again, data from Apollo, they actually may have peaked, and we kind of don't know that, but yet at least. I think we need to have more data before we can confirm whether this is a peak or it's some kind of maybe a false interim peak and they're going to continue to grow. It's very hard to tell, but delinquency and the health of the credit markets is something that is, I think, really vital to our banking system. We've got a lot of financial institutions that are carrying rather large paper losses on a lot of the investments that they hold because interest rates have moved up. But again, if we're holding the line, if we've seen maybe the worst from an interim standpoint of the credit exposure that we're going to see, then I think we've weathered it very well. Here we have delinquencies on consumer credit cards, and very interesting here again from Apollo that when you look at large banks, those delinquency rates have picked up. Again, like we talked about last slide, we think that this may have troughed, or excuse me, it may have crested rather, and we may be rolling off the top here. But when you get outside the largest banks and you get down to the community bank level, these delinquencies are much higher. And you think about the backbone of America is and the growth of the heartland, so to speak, is really measured by the health of all of the kind of the other, I'll call it 390 or 3,900 rather banks in the country that are not named Bank of America, JP Morgan, Wells Fargo, etc. And so obviously we want to make sure that this data continues to slide as it looks like it is likely to do based on the last slide that we looked at. And then you got delinquencies on auto loans. It's really kind of a very similar dynamic to what we saw with credit cards. You can see here, this is broken out by age cohort. But in a couple of cases here where we've got people that are kind of in the midst of their peak earning years where that delinquency is still rising, but you've got other areas of basically the auto loan market where that's now dropping. We'll talk about the office sector for a couple minutes here. That you've seen that we are down basically 40% from the peak on price per square foot. We've definitely seen a kind of a re-rating of risk in the office sector as the market struggles to kind of come up with the path forward on what office is going to look like. But clearly much more of a bargain than it was, and I think a recognition of a lot of the absorption that's going to need to take place in office before that market really begins to take off again. We've got commercial mortgage-backed securities, delinquency rates, and not too surprisingly, office leads the way. You can see here going back to roughly, we'll call it 6 months. We are showing some momentum that's picked up a little bit. We've got lodging, multifamily that are kind of, maybe some of these have gone up a little bit, but not nearly as much as the office side. Multifamily is an area where we've seen a fair amount of delinquency rates, which is very interesting because we have had, I would argue, some overbuilding in multifamily. That was an area that not too long ago was a very richly funded area by not only the commercial banking sector, but also the non-bank sector. Just a quick update on that. This is a survey from the National Federation of Independent Business of small businesses, asking them if it's a good time to expand. And you can see here that we've had a fairly strong drop, even though that we've seen a little bit of a fishhook here. We basically have about 10% of the population responding to the survey feel like it's a really good time to expand. I thought I'd spend some time kind of talking about China. We've kind of hit China in passing, but really when you think about the Chinese economy and their demographics, I mean, there are some fairly systemic issues that China is going to be dealing with over the next decade. And first, we need to talk about maybe the relationship with the U.S. economy. And you can see that basically we're less dependent on China as they are on us than we used to be. We basically went through, we probably peaked before some of these initial tariffs went in during Trump 1.0, and that has persisted ever since. This probably some of this was driven by pandemic supplies and whatnot. And obviously, there's plenty of industries that are that are going to take a while to onshore or nearshore or friendshore or whatever we want to call it. But the impact of the Chinese and U.S. economies on each other is still very great, but it's declining in its importance over time. Interesting here that we're actually importing more from Mexico. And so we talk about the importance of our nearest and dearest trading partners, Mexico and Canada. And I feel personally the importance on us reaching amicable trade agreements with those two partners. It is important to note that amidst this decline in net trading activity with China, that you see how Mexico is asserting itself in the data. Some of the demographic issues in China, again, this is all like from Apollo, and this is really, really good data. And they've got a whole package on China, and these were the most interesting excerpts from that. But think about this, like at the beginning of this century, like basically 25 years ago, there were 10 workers for every retiree. Now there are 5. So China, from an aging standpoint, is seeing some very tectonic demographic changes in a relatively short period of time. You see population growth is actually going down. You see the urban areas are still positive, but you can see that rate of change is pretty dramatic. And again, this is something that people have been watching for a very long time. here. And the rural areas, just as we've seen in other countries, including the U.S., where people are moving from the countryside to the cities. That's clearly taking place in China, where that growth has been negative for a long time. But the takeaway from this is that deceleration in population growth overall. We got China aging. Now, this is something that is clearly talked about a lot, and I would argue that the situation's even more acute in Japan, that has very stout immigration controls on it. But you can see here, China, we were at a higher run rate than China, and are frankly still now. But the rate of gain in China of its aging population, because of the one-child policy that was implemented or in implementation for so long, is going to cause China to basically eclipse the U.S. in a matter of years and continue to move much, much higher. Something else that we've talked about in bits and pieces over the last few months has been the Chinese holdings of Treasury securities. And you can see here, we were talking not too long ago, basically before the pandemic and that decade, about 1.2, 1.3 trillion, and that's now about 750 billion, and continuing to move lower. And in fact, this headline is just think about this: 500 billion that China is holding in U.S. Treasuries in just the last 4 years. Still talking about China, we've got pretty high debt levels, particularly in the corporate sector. You can see corporate debt as a percent of GDP, and you can see this basic trend, which is pretty spellbinding here. And then you've also got credit to non-financial sectors as a percent of GDP. So China is becoming much, much more leveraged. More on the China side, we've got more companies in China that are experiencing losses, and you can see that has moved up consistently. Actually, I'd say the pandemic really didn't do much of anything to this trend, except perhaps accelerate it a little bit. But you can see that this is very, very notable. So amongst the other things that are going on in China, the financial sector, real estate sector, now we've got a higher percentage of Chinese private firms that do not make money. Well, just as we talk about credit quality in the U.S., we certainly need to look at China as well, being the second largest economy as a standalone in the world. And you can see that non-performing loans here in these blue bars continues to move higher. So some of this, I think people might argue, is this is what happens when you become a maturing economy and you kind of exit the emerging phase. But it still is an issue that the government has to deal with. And so, I think we've already shown you a lot of data today that shows you that China has real things that they're wrestling with. You can see net interest margins are continuing to slide for Chinese banks at the same time that they've got a higher percentage of non-performing loans. Actually, this is not a percentage. This is actually trillions of Chinese yuan that are now non-performing. You got household debt to GDP in China. As we look at the gray bar, this is kind of our area of focus. So household debt, you can see consistently moving higher here. 2024 was a little bit of a step back, and that I think should be recognized, but the trend is clearly up at the same time that we've had some declines in the US over time. And you've seen Germany, which at least lately has shown a little bit of improvement. Real estate investment is slowing. When we've talked about the quality of real estate investment, there's a lot of vacancies in China, not only residential but also commercial, and you can see investment slowing down, and a lot of the real estate firms are certainly exhibiting some fairly strong financial stress. real estate investment period. In China, you've got U.S. real estate investment as a percent of GDP. You can see, if anything, that's probably net increased. But you can see in the Chinese side in the green, you've had a really noticeable drop in real estate investment over the last half decade or so. Residential transactions are also falling. So here's another facet of the real estate market in China that is struggling at the moment. As I mentioned before, you've got vacancy rates in both Tier 1 properties, Tier 2 and Tier 3 right here, that outside of Italy, everybody else is at a much lower level. So a lot of overbuilding, a lot of retrenching in real estate. Obviously a lot of troubled loans because the model is for development is that you're going to have you're not going to have vacancy. You're going to have tenants that are going to pay economic rent to you that gives you a return on investment. And if that's not happening, if you've got these high vacancy rates, then you're going to go bad. You're going to go belly up on your loans, and that's exactly what's happening in China right now. And we've got just a couple charts to finish here. We've got Brent crude, which not surprisingly moved higher on the announcement of the Israeli airstrikes on Iran. And also, not surprisingly, you saw a little bit of flight to the precious metal. And gold has had a very strong run over quite an extended period here. Again, flight to quality because of geopolitical concerns. Something that I've talked about a lot is goods versus services, and the share and the importance, the relative importance of each on the U.S. economy, and on and we're talking about this as personal consumption expenditures. So basically spending. So and I keep telling you that goods are kind of like the manufacturing sector proxy here. Less important over time. This goes back to that would be 1995, the first quarter of 1995. And meanwhile, the services share has gone up. We're talking about like 2/3 of the economy. So consumers and services are the drivers of the U.S. economy. So all the charts we have this week. I hope you've enjoyed it. Have a great week, and we'll talk to you again soon.